What is going on, my friends? Ryan Williams here, back with another one. And in today's video, we are going to be talking about the best dividend stocks to buy in January of 2022. I cannot believe we are this close to being in the new year. It is unreal. Now, today we will be covering 4 different dividend paying companies that look like pretty good buys as we make our way into the new year. And just so you guys know my criteria, I chose these 4 specific stocks based on how they're currently valued, how they've been performing recently, and also because of their dividend stats, which I am very excited to get into because we have a pretty good mix of stocks on deck for today. We've got some high yielders, we've got some that are more high growth, and we even have some dividend kings. Anyway, before we get rocking and rolling, if you are stoked to learn about some great dividend stocks to buy in this upcoming month, go ahead and give this video a big thumbs up. Also, leave me a comment below and let me know which stocks you guys are planning to buy to kick off 2022 with a bang. I'd be very curious to hear what you guys are looking at. Anyway, thank you so much for doing that. And now, without further ado, let's get into it. All right, my friends, before we get into the batch of stocks that we are going to be discussing today, I first want to do a little recap and just review the stocks that I chose for the best ones to buy in December. I want to go and take a look and see how those performed in the last month to see, if you were to take my, I don't want to call it advice, but if you were to watch my videos and buy the stocks that I'm talking about, how would you have fared so far? So in case you guys didn't get to check out my best stocks to buy in December video, the 3 that I chose for that particular video were Allstate, Intel, and Lockheed Martin. 2 of which I have in my own portfolio, and then 1 I am heavily looking at, this Allstate right here. I'm highly considering adding it, but just not quite there yet. But I've been buying up Intel, I've been buying up Lockheed Martin like none other. You guys know this if you've been watching my videos. And as far as their performance in the last month, if you were to buy them, when I first put out this video, about a month or so ago, you probably would fare pretty well, actually. Surprisingly, in the last month, in the last 30 days, Intel is up 2.5%. Allstate is up 1.23%, and Lockheed Martin is actually pretty flat, only down 0.2%. So not much movement for Lockheed Martin in the last 30 days or so. So I would say overall, you'd be up probably a little bit if you would have bought these stocks at the end of November or going into December. Anyway, with that said, guys, let's now move on and get into the best stocks to buy in January. All right, my friends, now we are going to kick things off here with Enterprise Products Partners, ticker symbol EPD. Now, this is a stock that I personally have in my portfolio. It is a midstream company in the energy sector. And one particular thing to note about this company is that it is an MLP, a master limited partnership, as can be seen from this LP at the end of the name here. And MLPs are a little bit different than other companies like a Procter & Gamble or a Coca-Cola in the sense that at the end of the year, come tax time, you will get what's called a Schedule K1, which is just a different form that shows the distributions, not the dividends, the distributions that you get from owning this company. It's kind of different names for the same thing. You still get a pretty sweet dividend from owning EPD, but we refer to them as distributions. And there's a lot more that could be said about MLPs, guys. I highly recommend you do a little bit more research on them if you're going to be investing in companies like EPD, because there are some intricacies that you should be aware of, especially as it pertains to how you're taxed from owning them. But we'll save that for another video. For now, let's get into the share price performance of this company, which, as you can see, really hasn't done too much in the last year. It's only up 3.71%, which really isn't too much movement. Zooming in a little bit closer, in the last 6 months, they've seen a pretty steep decline of 12.81%. And then in the last 30 days, they're down another 3.36%. And then just this week, they're, pretty flat, 0.38% loss in the last 5 days. Nothing too crazy. Now, before we go on and talk about the valuation of this company, I want to scroll down and see what the bulls have to say. So the very first one right here says EPD is very inexpensive, resilient, and it offers a high and secure dividend yield of almost 9%. This guy spilled the beans. I didn't want to reveal that quite yet. But yeah, EPD has a very high dividend yield, almost 9%, which is definitely one of its more attractive qualities. Moving on to the second one, very attractive yield, yep, and deeply undervalued. Okay, very cool. And then the third bull right here says the sell-off in EPD units is overdone, and investors who buy today will reap attractive long-term rewards. Well, that's great to hear. So far, just in terms of how it's been performing across time, the stock really doesn't do much in terms of capital appreciation. So if having the share price of the stocks you own increase is something that is pretty important to you, which I know a lot of you, that's something that's important to you. So if that's something you're looking for in an investment, EPD may not be your best bet. However, if you're an income-focused investor, there's a lot to love about EPD because like we read a moment ago, it's got a really high dividend yield. And we'll see in just a moment that they also have a pretty attractive dividend growth history as well. But before we get to that, guys, let's jump over to the valuation page and get into that a little bit more. So on this page right here, we can see that Seeking Alpha gives EPD a valuation grade of a B-, which really isn't too bad. Okay, they have a forward dividend yield of 9.7, which in the single digits, that's pretty dang solid. This PE ratio happens to be over 30% lower than the company's 5-year average PE ratio. And then additionally, it happens to be 13% lower than the sector median. So compared to its previous self and also compared to some of the competitors in this space, EPD does seem to be at a better valuation right now. And that's just based on the PE ratio. I mean, if we scroll down here, we'll take a look at the price to book, which right now is 1.83 for the forward price to book, which is considerably lower than the 5-year average price to book by 20% or so, but it is 15% higher than the sector median price to book. So that might not be the best thing, but overall, guys, a 1.83 price to book is not too bad, not too shabby at all, if I do say so myself. And then if we look at the price to cash flow real quick, this isn't too bad either. In the single digits, 6.07 for the forward price to cash flow, which is a lot lower than the 5-year average, but is about 13.5%. Don't exaggerate it, Ryan. 13.5% higher than the sector median price to cash flow. So I guess, you know, all these things combined, the PE ratio, the price to book, the price to cash flow, I guess it makes sense to give this a B- grade. I mean, compared to how the stock has been, it is trading a little bit more affordably, but compared to some of the other companies in this sector, probably some of the other midstreams, it could be a little bit pricier. Not based on the PE ratio right here, but we definitely saw that with the price to book and the price to cash flow. So that is something to keep in mind as you're researching this stock. Now I want to do something a little bit different. I want to jump over to this profitability page. We really don't spend too much time on this, but two metrics that I feel like I should start talking about and really learning more about are the return on equity and the return on assets. Now, there are some slight differences between these two metrics, but both of these we can use to determine how effective a company is at generating a profit. And what we are going to do is we're just going to be comparing these two metrics to the sector medians to see how effective this company is at generating a profit compared to its competitors. So we can see, looking at the return on equity here in the last 12 months, 15.64% is, according to Seeking Alpha, 460.93% higher than the sector median. So they're doing a pretty great job compared to their competitors of using the equity to generate more profits. And also the same is true with the return on assets, which are currently 5.86% compared to the sector median of 1.03%. So overall, I'd say these are looking to be in pretty good shape. But to be honest with you guys, I'm still quite new at taking a look at these particular metrics, the return on equity and the return on assets. So I'd be curious to hear your guys' thoughts on these two in the comments below. I've heard a few things so far about these two metrics. I've heard a return on equity, like a good rule of thumb to look for, is 12% and above. But I also know that that depends on the type of business. So it could differ there. And then I've read that a good return on assets to look for, I think I've read a couple things, either above 1% or above 2% is kind of the rule of thumb. Either way, EPD is blowing this out of the water on both fronts here, return on equity and return on assets. And now with that said, guys, we're gonna keep it simple and just jump over to the dividends. And let's go take a look and see what those are looking like here. So scrolling down, as we talked about just a moment ago, the dividend yield for EPD is very impressive. Currently 8.58%, with a payout ratio that is pretty dang high, 83.26%. But one of the things about master limited partnerships, guys, is they have to pass on their profits to us investors, which are actually owners of the company, which is why we get a K1 at the end of the year come tax time, instead of it being shown on our 1099s from our brokerage. So that probably explains this high payout ratio right here. Not very concerning for a company like this. Moving on to the 5-year CAGR, the 5-year growth rate of the dividend, that's very low, currently 2.5%. Really not much to speak of in terms of dividend growth, but their yield is high enough that I do think we can look past that. It's not very common to find a dividend stock that has a high dividend yield and a high 5-year growth rate. The only example of that I can think of off the top of my head is Altria Group, which has a pretty similar dividend yield, and I think the growth rate of Altria Group is like 8-something%. It's considerably higher than what we're seeing here. But normally, guys, this is expected. High dividend yield with a low growth rate. On the inverse of that, you'll find a lot of stocks that have a low starting yield, but a high 5-year growth rate. So it just depends. There's usually a trade-off, but I don't mind it. This is a really nice dividend yield. And like I mentioned earlier too, they have a pretty respectable dividend growth history. 22 years of consecutive dividend growth, which is great to see. All right, my friends, moving on to the second stock of the day, we are going to be talking about Target, ticker symbol TGT. This is a stock that I have on my watch list and I would love to add it to my portfolio. I think we're getting pretty close to being there. It still has a little bit more room to come down, but Target has seen some pretty steep declines in share price recently, and we will go through that right now. Starting with the 1-year performance, it has grown 28.13%, which is actually not too bad of a return in the last year. But zooming into the last 6 months, they are down almost 6%. And then zooming in even more to the last 30 days, they have seen a 12.22% decline in share price, which is a pretty big drop in a short amount of time. With that said, I think that's a pretty good start. I still think Target has a little bit more room to come down, guys, but we will be taking a closer look at that in just a moment. Before we get there, I want to scroll down and see what the Seeking Alpha Bulls have to say. Now, the first one right here says, recent stock slide despite another quarter of beating expectations. Gives investors a rare opportunity to purchase shares in this dominant retailer at a discount. That's pretty good. And they mentioned beating expectations. I want to scroll down, look at the earnings per share and how that has played out. So for the last 5 quarters in a row, they have just slammed earnings expectations. It's been a pretty good year for Target as far as beating earnings go. That's maybe neither here nor there. It's good to see beating the earnings estimate, but really at the end of the day, like what are these estimates? Do they really mean that much? I don't know. There's probably different schools of thought on that. But at any rate, let's go back and see what the second bull has to say. Target stock price offers an attractive entry point for a company with solid business model and strong dividend growth as inflationary pressures and supply chain pressures ease. So all pretty good stuff, guys. Target has a lot going for it, as we can see just from these two opinions right here. But let's scroll up and take a closer look at the valuation and see what things are looking like there. Okay, so according to Seeking Alpha, it's not too great. Target actually has a lot more room to come down because they give the grade an overall D+, which isn't great. But I will say that the forward PE ratio really isn't too bad. 16.61, that's below the rule of thumb of 20. We like to see a PE ratio below 20 if we're talking deals and discounts. So 16.61 is within that criteria. However, it is currently a little bit more expensive than the sector median PE ratio of 14.37 by 15.58%. So Target definitely still has some room to come down. Hopefully the decline in share price will continue. But continuing on, guys, looking at the price to book, this is exceptionally high. Forward price to book of 7.91, which is over double the sector median price to book. So this is a pretty big thumbs down for Target. Okay, this price to book is just dramatically high. And then the price to cash flow, guys, really isn't that great either. Forward price to cash flow of 11.49. And it begs the question, like, if that's true, then, why are you recommending we buy it for January? Why is it one of the best stocks to buy in January? Well, guys, that's a great question, and I'm glad you asked. I mean, Target is just a beast of a company. We're going to take a look at a couple more metrics like the dividend stats and the profitability and stuff like that here in just a moment. But Target's a great company, and it is pretty rare to find it at such a steep decline in share price right here. I mean, just recently at the end of, or like mid-November, over a month ago, was at $264 per share, which is a lot higher than where it's at now, right? That's like between 25 and 30% higher, I think. So it's at a pretty good discount right now, which is why I'm thinking it might not be a bad time to start dollar cost averaging in or pick up a few more shares if you are a current shareholder of this company, because, it could go back up any day now. And the market is so crazy, you never know what's going to happen. But anyway, guys, let's now move on. I want to take a look at the profitability real quick. We're going to take a look at those same two metrics, return on equity and return on assets, starting with the return on equity right here, which is 50%. Oh my gosh, that's almost 200% higher than the sector median return on equity, and also 70% higher than this company's 5-year average return on equity of 30%. Moving on to the return on assets, guys, 12.46%. That is twice as high as the sector median return on assets. So Target is just crushing the game right now, guys. And I guess these are two reasons why Seeking Alpha gives it an A+ profitability grade. Now let's move on and talk about the dividends. There are some things to like about this dividend for sure. Scrolling down, they have a forward dividend yield of 1.64%, which really isn't the highest. Okay, that's actually a relatively low dividend yield, if I'm being honest. But they do have a payout ratio that is pretty reassuring, 27.18%. That's a very low payout ratio. To me, that means that this dividend really isn't stressing the company out too much financially, and hopefully indicates that they'll be able to continue paying it. They have a lot more cash flow to contribute to the dividend if they wanted to. So I'd say the dividend's in a pretty good spot. Now moving on to the 5-year growth rate, this is pretty average right here, 6.38%. It's really not super duper high, but it's really also not a low 5-year growth rate either. I'd say it's pretty run-of-the-mill, pretty right in the middle. What is really standing out about this dividend is the dividend growth history. 53 years of consecutive dividend growth, making Target the first dividend king we are talking about today. This is dividend royalty, guys. That is one reason why you should consider adding it to your portfolio. Gotta love those dividend kings. All right, guys, now moving on to the third stock we are gonna be talking today. This is one that I've been talking about more frequently in my videos. This one is Leggett & Platt, ticker symbol LEG. Now, this is the second dividend king on our list to talk about today. I shouldn't have spoiled that, but it's true, and LEG has not been performing well at all in the last probably handful of years. We're going to take a look at all these time periods, but starting with the 1-year performance, it is down 6.3%. Zooming into the last 6 months, it is down almost 24%. Oh my goodness. And then moving on, last month's performance, guys, or in the last 30 days, it's down about 8.5%. So another pretty steep drop in the last 30 days. But then if we zoom out even more, guys, taking a look at this 5-year performance, it's really done nothing good, nothing worth mentioning in the last 5 years as far as capital appreciation. In fact, it's down almost 23% for the last 5 years. And then zooming out to the last 10 years, it is up 66%, almost 67% in the last 10 years. But guys, in the last 5 years, it is just like from 2016 till now, Leggett & Platt has definitely not done anything for shareholders besides dividends. But what it does with dividends is pretty dang good, which we'll see in just a moment. Before we do, I want to scroll down and take a look and see what the bulls are saying. And we have 3 to talk about. The first of which actually comes from the Dividend Diplomats. I know that logo right there. Shout out to Bert and Lanny. Those guys are crushing it. Go check out the Dividend Diplomats channel if you have not seen any of their videos. Those guys are a couple dividend rock stars, I gotta tell you what. But Bert and Lanny say that the company dominates a sector that is needed in every single household. And for those of you who don't know what this company does, just real quick, they design, manufacture, and market engineered components and products worldwide. That's pretty vague. But specifically, guys, they make bedding products, furniture, flooring. I think they even make things like car seats, like the seats that you actually have in your cars, not car seats for kids. Mattresses. It looks like they manufacture a ton of things that just have to do with sitting and laying down. So they make a lot of comfortable things. Moving on to the second bull right here. When supply chains stabilize next year, we should see a good improvement in margins. From this perspective, the stock currently looks like a good buying opportunity. And then moving on to the third bull, share price is lagging strong EPS growth, with a current dividend yield of 3.5% and prospects for total returns of about 8% to possibly up to 25% per year over the next 3 years, LEG appears to be a suitable stock for DGI investors. All right, so all pretty positive stuff, guys. Now what we are gonna do is scroll up and take a look at the valuation to see what is going on there. So Seeking Alpha gives it an overall grade of a B, which is not bad. Okay, they have a forward PE ratio of about 14, which is right on par with what we're seeing on the sector median right here, and also is about 23% lower than this company's 5-year average PE ratio, which makes sense because from what we saw on the share price performance, this company has done nothing but go down in share price in the last 5 years, right? Now scrolling down, guys, taking a look at the price to book, forward price to book of 3.29, which isn't too bad. You know, a perfect price to book really is 1, and anything above maybe like, I'd say anything like 3 and above, I start to be like, I don't know. But you know, 3.29, it's not terrible. The sector median is 3.32. So it's like right in line with where some of its competitors are at. And then the price to cash flow in the trailing 12 months is 17.11. And they actually don't have a recorded forward price to cash flow. And that is because this company so far in 2021 has done negative cash flow numbers, and that's why we're not seeing anything right here, and hopefully that turns around in 2022. Like that bull was saying, hopefully, you know, once supply chain issues kind of kind of work themselves out. Hopefully we should see those margins improve, and we'll see positive cash flow come back for LEG. And on that note, let's scroll up and go look at the profitability real quick. Take a look at the return on equity and return on assets, both of which are looking pretty good. Okay, the return on equity is almost 28%, which is 61% higher than the sector median. And then the return on assets is also looking pretty good, 7.63%, which is almost 30% higher than the sector median return on assets. So both of these metrics are looking pretty strong. Seeking Alpha gives the profitability for LEG an overall grade of C+. Now, guys, let's move on and go over to the dividend. And scrolling down, the dividend yield is looking pretty sweet. LEG has a forward dividend yield of 4.38%. And their payout ratio is not too bad, maybe just a skosh high, 61.31%. I kind of like to see this, for a company like this, maybe below like 60%, but a little bit above that. It's not a deal breaker, and the payout ratio isn't something that is fixed. It's something that changes as time goes on. So they could even lower this payout ratio moving forward, but that probably will not be the case if they are not generating cash flow. So like I said, that's just something you need to keep in mind as you're looking at this company. Moving on to the 5-year CAGR, the 5-year growth rate, 4.38%, which coincidentally is the exact same percentage as the dividend yield. I've never seen that before. And then according to Seeking Alpha, they have a dividend growth history of 29 years, but that is not accurate. LEG is a dividend king. If we scroll down, take a look at these analyses, like it says it in multiple headlines right here. LEG, an underappreciated dividend king. Where else? LEG, the dividend king has risen. LEG, a soon-to-be dividend king. This is from February of this year. So this company just hit its 50th consecutive year of dividend growth, and I really don't know why Seeking Alpha gives it only 29 years of growth. Sometimes it does this. Like, I've noticed a couple inconsistencies with Seeking Alpha and how they're reporting the dividend growth. So I don't exactly know why that is or what's going on, guys, but LEG is a dividend king. That's really what's important. So, all right, guys, and then moving on, last but not least, we are going to be talking about Best Buy. Ticker symbol BBY. And I know I just talked about Best Buy in one of my recent videos. Same with LEG, but guys, these two companies in particular are looking too discounted, not to mention, and are looking almost too good not to buy in the upcoming month of January. So Best Buy in the last year is down 5.63%. And then zooming into the last 6 months, they are down 10.3%. And then guys, get ready for this. In the last 30 days, Best Buy is down a whopping 28.39%. Have you ever seen anything like it? Probably, but it doesn't happen very often. You know, this is an unreal drop in share price. When I think about that, it blows my mind, guys. And if we zoom out back here, you can see it at its peak recently at the end of November is at $138 even per share. Okay, and then this right here is looking like, if it was a ski slope, it'd be a double black diamond, because this is one of the steepest drops I've seen in my short time as a dividend investor. But nonetheless, guys, definitely indicates there is a discount going on here. And Best Buy is also very close to reaching a new 52-week low. And I do think it can get there. All right, guys, and I know we literally just talked about this company, so I won't get into what the bulls have to say. There's really nothing too interesting going on there. So let's just go over to the valuation page and see how Best Buy is currently valued. So Seeking Alpha gives it a B, overall grade of a B. The forward PE ratio, guys, is looking pretty sweet. 9.7 in the single digits. That's an extremely low PE ratio. This also happens to be 30% lower than the company's 5-year average PE ratio, and also just above 30% lower than the sector median PE ratio. So compared to some of its competitors, Best Buy is looking to be more affordable by a considerable amount, I'd say, by 30%. And then also, if we scroll down, take a look at the price to book. I gotta say, this actually is surprisingly high, 5.76 compared to how low the PE ratio is. And none of these metrics is the end all be all. It's good to kind of cross-reference amongst the three. But I will say that this price to book could be better. And it is also considerably higher than the sector median by like 74% almost right here. And then moving on, the forward price to cash flow actually, contrary to the price to book, looks pretty good. Single digit price to free cash flow of 8.28, which is 32% lower than the sector median. So I'd say overall, guys, this is looking considerably more affordable than maybe some of its competitors. Like Target could be a competitor, a Walmart could be a competitor. And we already know Target's valued a little bit more expensively, right? It had a price to book of in the 7s, and then it had a PE ratio that was about double what we're seeing here. Maybe No, not double. It was like 16, right? Somewhere in the 16s. But at any rate, guys, Best Buy does appear to have a little bit better valuation than what we saw with Target. Now, guys, let's jump over to the profitability. Take a look at the return on equity, return on assets. Starting with return on equity, that is looking golden. 63.22%, which is 267% higher than the sector median return on equity. And then they have a return on assets of 13.15%, which is 121% higher than the sector median return on assets, which is great. This company's killing it as far as profitability goes. And Seeking Alpha seems to agree. That's why they gave it an overall grade of an A right here. Now, jumping over to the dividends, guys. Best Buy's got some pretty solid dividend stats going on. So scrolling down, they have a forward dividend yield of 2.87%, which isn't super low. Okay, it's not considered high by any means. We would consider like 4% and above to be a high dividend yield, but 2.87% is respectable. I'm not mad at it. They have a really low payout ratio of 27.85%, which is great to see. And they also have a 5-year growth rate of over 20%. That is just so sweet. I need more of this in my portfolio, guys. 20% 5-year growth rate. This is one of the things that is very enticing to me about Best Buy. And then moving on, Best Buy has a dividend growth history of 8 consecutive years, which, you know, we've seen more, we've seen less. 8 years isn't too shabby, but they do have 17 years of consecutive dividend payments. So at least there's that. And if we zoom out on this slope right here, guys, I think we'll see a pretty nice upward trajectory right there. Look at that jump between 2020 and 2021. Unreal. That's like a 30% jump right there. All right, my friends, now at this point in the video, we would normally do a, weekly portfolio update, but I'm actually recording this video on Wednesday, December 21st, and there just really hasn't been anything going on in my portfolio. I have not bought my stocks yet for the week, although I do plan to buy Intel and Lockheed Martin and probably some AT&T. But really nothing's been going on in my portfolio the last couple of days, guys. So I figured it'd be better to hold off on the dividend portfolio update since nothing's happened. We do have a pretty good monthly dividend portfolio update video coming up here very soon. So figured I would hold off for that. I apologize if you guys were looking forward to my weekly portfolio update. And if you have any questions on my portfolio, go ahead and ask them in the comments below. I'll be happy to answer. But otherwise, guys, that pretty much wraps it up for today's video. So thank you guys so much for taking the time to watch this video. I really appreciate it. And before you click on to the next one, I'd be very curious to know what stocks you guys plan to buy next month, in the month of January 2022, to kick the new year off with a bang. Leave me a comment below and let me know which stocks you're looking to pick up. Also, if you haven't done so already, please don't forget to leave a like, leave a thumbs up on this video if you enjoyed watching it. And also, if you'd like to see more videos from me on the topic of dividend stocks, go ahead and hit that subscribe button as well. At this point, I'm putting out 2 videos every single week on the topic of dividend stocks, most of which are analyses, kind of like what we do today. And oftentimes I'll even give you inside looks into my own dividend stock portfolio. So if that's something you'd be interested in seeing more of, go ahead and hit that subscribe button. And with that said, I will now get out of your guys' hair. But thank you once again so much for watching this video. I really appreciate it. Hope you guys have a great day, and I will see you in the next one.